Welcome to Influential Entrepreneurs, bringing you interviews with elite business leaders and experts, sharing tips and strategies for elevating your business to the next level. Here's your host, Mike Saunders.
Hello and welcome to this episode of Influential Entrepreneurs. This is Mike Saunders, the Authority Positioning Coach. Today we have with us Andrew Carrillo, who's president and founder of Barnett Capital Advisors. Andrew, welcome to the program.
Thank you, Mike.
Hey, so I'm interested to learn all about what you do and how you serve your clients, but get us started with your entrepreneurial journey up to this point in your career. What got you initially into the financial services industry back when you started your firm?
Yeah, so I started out majoring in finance, and I worked at a Fortune 500 company right out of college. And really at the time I started there, I saw myself retiring there. But then I realized that these bigger, large broker dealers, they really try to push a lot of proprietary products. They aren't really about being in the best interest for the clients. And so that's when I started my own company, and we're fiduciaries and structured as a registered investment advisor called Barnett Capital Advisors. And so that's really what got me, along the journey, was first starting at that Fortune 500 company. And what got me really even into finance is I realized a lot of my relatives, growing up had bad financial advice, and there's a lot of advisors were, exposed to different conflicts of interest. And I really wanted to change that and help clients in a more honest way.
That's an interesting point about conflicts of interest. So I want to tie together fiduciary to conflicts of interest. So define what an example would be of like a conflict of interest. Is it like what I'm thinking, where you work for XYZ company and all you can sell is their products, but something else is better out there, but all you can sell is this certain suite? But kind of clarify an example of conflict of interest, and then how does being a fiduciary help set your clients' minds at ease to know that you must provide to them the best advice?
Exactly. So really a conflict of interest is the most common one I see are through brokers. So most advisors are calling themselves fiduciaries nowadays, but a broker, if you're on FINRA broker check and it's active, you can receive compensation that the client doesn't see. Okay. And so the largest one I saw at this Fortune 500 company I worked at was the real estate investments. These real estate investments would pay advisors huge commissions underneath the table, where if you're a fiduciary, you might make just 1% a year, and you have to, grow the account. You have to keep the client. So that's really a huge conflict of interest, because it would push a lot of clients' assets into these higher, commission assets. Another one that's common is if an advisor or broker is compensated on making changes to the account. Okay. Right. Then they only see buy or sell, and they might not see hold. And sometimes hold is a good strategy. And so you don't know if he's buying or selling to pay the light bill, or if he's buying or selling because it's in the interest of the account. So by working with an advisor who doesn't have a broker license, you can be confident that they truly are fiduciaries. If you see them making a change to your account, they don't make any compensation from that change. And if they're recommending 10% here, 10% there, and creating a nice allocation for you, that for them, they don't receive compensation more or less from pushing you into different investments. And so they can truly objectively look at everything, look at your situation, and do what's in your best interest long term.
Yeah, that's a really good point. And so what you're describing is like, if you explain to someone that you get paid by assets under management. So you could move, and correct me if I'm wrong, but in that scenario, you could move funds 10 times a day, and it's not going to trigger any charge to the client, because you are trying to position them in the best way possible to grow the portfolio. Whereas what you described was, if you make moves, then that's going to trigger some fees and some commissions that way.
Exactly. So as they do better, we do better. Yeah. And it's a lot of these, the real estate trusts that are high commission products that the clients don't even know. For every $1 million, the advisor can make $70,000. Or for every $1 million in assets under management, they might make $800 a month. Yeah. And so that can really steer people's judgment. And if the investment's that good, why do they need to pay? They're enticing people with these huge, commissions on them. And so that's usually not in their best interest.
Yeah, that's a really, really, really good point. And so isn't there also another aspect of being a fiduciary where, it's not just, saying that I do the best for you and I have to, there's a legal aspect. So it's like you're held to a standard that Andrew Carrillo has to give the best advice, or else you're going to be in jeopardy of some retribution, right?
Exactly. Yeah, it's the same. It's one of the highest standards under law. It's the same standard that a trustee of a trust. So it's really looking out for their best interests. Exactly.
So let's talk about how you serve your clients. So you're typically focused on helping them with retirement. What is your approach to when you're working with a new client? What is your approach to retirement planning? And what have in your years of working in the business, what have you noticed? You said that you noticed when you worked for the Fortune 500 company that you noticed, well, I didn't like this or this. Well, when you're also noticing in the industry when advisors are talking to their clients about retirement planning, what is missing? What are some of the things that the clients just don't even know that they don't know and that you're bringing to the table to make sure they're fully cared for?
Exactly. So I think one of the most important things is running your numbers and seeing where you are today versus where you need to be, and preparing your portfolio for different things that can happen in the markets. Right? Because part of retirement planning is understanding that markets do go down, and so in 2008, 2009, I met a lot of people that weren't prepared for a downturn and they were about to retire. And then they ended up making an emotional decision and panic selling towards the lows. And so this isn't something that should be a shock, right? We know markets over time do increase dramatically, but we should have a plan in place that positions us to take advantage of if the market does go down, but two, to be ready and to understand, look, I have this money over here that's somewhat more conservative. If I need money, I'll pull from there. So I'm not going to panic sell my whole portfolio. So I think that's one of the most important things is to run your numbers, get everything on paper, and then that all your investments have a purpose, right? Not just putting stuff because it's tradition into certain assets, and understanding where you are from a risk spectrum so that you can feel comfortable. Even if your advisor says, oh, you should be aggressive or you should be moderate, you need to agree with it too, because you're the one that has to be confident as you're going through this volatility, that you can sleep at night and that you can go through the entire investment cycle.
Yeah, that's a really good point about volatility and kind of like don't react, respond. And be prepared. It reminds me of like if you have a plan for when my kids were little, we would have a plan if the house was ever on fire, we need to all meet here. Then if it happens, you're still in a flurry, but you have that in the back of your mind of, okay, I need to do this. So you need to realize that if you look at the market over the last 1 to 2 months, maybe these lines are going up and down, but if you looked at it in the last 1 to 2 decades, it's kind of this gentle move. So it's so much more volatile in the moment. So don't react. Just kind of know that, okay, we've got the plan in place. So what do you say to your clients when they do call and go, oh, this happened, we need to do, no, hold on, stay the course. So, I mean, I think it's that perspective, right?
Exactly. And that's part of knowing your numbers and where your assets are positioned. So if we know we're withdrawing a certain amount every month, to pay your lifestyle, we know that there's a certain amount that's conservative that if the market were to take a bigger decline, we can pull from. So we're not necessarily selling assets lower than we need to be. So we have different levers we can pull. And I think that part psychologically helps you, and it just helps you even from a data, quantitatively, because you're not, you have a different conservative bucket that you can pull from. But I do think a lot of this is psychological, and it's about getting through. And so by understanding that versus, that you have that conservative money versus if you did have 100% in growth stocks or something very aggressive, it would be very volatile. And most people in retirement don't want that. They want to have low blood pressure. They want to be relaxing on the beach, spending time with the grandkids, and just getting the returns they need without excessive risk.
So when you think about age and risk and volatility and things, do you think that, I don't know that this exists or not, but it's like, okay, if you're between this age and this age, then your risk tolerance should be this. But when you move into this age, then there isn't really buckets, right? I mean, everybody's situation is different, but it tends to be the closer you get to retirement, you need to be really careful and wary of that risk factor to keep it as low as possible because you don't have any room to recover if there was a bump.
Exactly. You're right. I don't think it's as cookie cutter as just, it's 50-50. If you're 60, you need to be 60% in fixed income. It really depends on, everyone's different. Their personalities are different. Their ability to handle volatility. Right? Some people, they see the volatility and they're like, but other people get very nervous. And so it depends on that, but it also depends on your overall situation. So, what is your portfolio level at versus what are your withdrawal needs? Right? And so it's a combination of what your needs are versus your tolerance for the risk and your ability to get through it.
Yeah, that's a really good point. Is again, knowing your numbers, being prepared, knowing the outcome, like begin with the end in mind, like we've heard for so many decades, and just know what that looks like. Well, nobody knows what the actual end is. We need to plan to live to be 80, 85, 90. We don't really know that number, but you need to have that good gauge of a number that you need to be comfortable with because people are living longer these days. I think we're all as a society are eating better, taking better care of ourselves health wise and exercise wise. So I think maybe people need to prepare to go, okay, it used to be you'd retire at X and we need to plan for this other age, but maybe that needs to be expanded out a bit, right?
Exactly. Yeah. And there's really a retirement income plan, if done properly, should be able to hedge you against the 6 retirement risks. And the first one's inflation. If you ever mess with a retirement calculator, if you mess with that inflation number, that can drastically change the outcome. We're seeing some of the highest inflation right now in quite a long time. Also, healthcare costs are a big risk for retirees. Asset allocation risk, so the risk that you're either too conservative or too aggressive. And then longevity. So people are living longer and longer nowadays. So that portfolio needs to last longer than ever in history with record low interest rates or pretty close there now. We've had a little bit of an increase, but we're still relatively pretty low. And then last but not least, the 6th risk is excess withdrawal. And so they're pulling too much. And then also a risk there is taxes. The government spends a lot of money. And so they are constantly trying to increase taxes. So we want to do things as tax efficient as possible.
Yeah. And since we know that the government may raise taxes to close the gap of, deficits and all that type of thing. You can't sit back and go, oh, when I retire, I'm going to have, much lower tax base. We just don't know. You're earning less. So maybe the dollar figures might be less, but the percentage is just a big question mark. So you have to be careful on the front end. You have to be prepared so that you've got some good tax-free money that's coming in. So when you're working with your clients, what does your firm do that's a little bit different to help your clients achieve that outcome from maybe what they've heard from other advisors? Do you guys have a type of unique approach?
Yeah, I think one of the things we do, and it's been pretty contrarian. People are always shocked. A lot of when you run the numbers and you estimate tax brackets, it's very rare that people are in a lower tax bracket. They're either going to be in the same or potentially a higher tax bracket. And so it's always good to just run your numbers before retirement and see really what is estimated to be your tax bracket. Don't just assume because someone said you're going to be in a lower tax bracket that's the truth. And so then taking a look if you are able to get into some tax-free areas and to balance those withdrawals, right? And to have a mix of tax-free and taxable areas so you can withdraw from both of those at the same time. And that increases the likelihood of keeping your tax bracket low by having the 2 buckets. Because if you're going to pull 100,000 from a tax-free area and 100,000 from a taxable area, you can make 200,000, but the government only sees you making 100. And so a lot of people listen to their accountants on this, and accountants are all about saving you money on taxes today. But the way I look at this, one of the ways to look at it, I think, is it's similar like Shark Tank, right? By doing a pre-tax today, you're keeping the government as your partner.
Right.
And basically, every time you pull out money for the rest of your life in retirement, the next 30 years, you're going to have to pay the government a royalty.
Right. And that's a
Versus
partner
if
you
you
don't
buy
want
the
to have.
government out doing the after tax,
Yep.
then you basically are buying the government out when your business is small. You can grow that business as much as you want, and you don't have to talk to the government ever again. So it's a little perspective there.
Yeah, I
But
like that
everyone's
analogy.
situation is unique.
It's the silent partner that's not very silent.
Right, he shares with you in your profits, but none of your losses.
Yeah. Yeah, that's a great point. Well, you mentioned tax-free or taxable. If given the choice, everyone would say, well, I want tax-free, funds or money or access to tax-free. But you don't have that choice many times, mainly because I think traditionally you start off at your first job and you start that qualified account, 401k or whatnot, and you've got money that's growing in that. So at some point, maybe then the choices come to go, okay, I've got some other money that I can invest. What's the best way to put that in to toward retirement? And then there's some vehicles that can then grow after you've paid your taxes from your job. You've got your money, but now we're going to put it in a certain vehicle where now from that moment on forward, all of the growth is tax-free. So that's the thing that people need to keep in mind is sometimes it's inevitable. You're going to have some money that's taxable because you put it in the account before it was taxed on the front end.
Exactly. Yes. And more they're coming out with more tax-free options at employers today, a lot more than when I first got into business almost 16 years ago. Their options, pretty much most of the plans have it. So it is important. The more you have in pre-tax plans, the higher probability that you're going to be in a higher tax bracket. The more you can balance that out, it actually gives you a higher probability that you'll be in it's going to lower your tax bracket by having different buckets you can pull from on average.
Yeah. And you can't just look at this one bucket and go, ooh, that sounds really good. I'm going to now just focus every single thing and put it all there. It might be safe and all, but you need to have that balanced, mixed approach. So what are some of the buckets that you would recommend for people to be considering based on their situation?
Yeah. So buckets from an investment standpoint in retirement, I think it's good to have three main buckets. Of course, a cash reserve for liquidity, emergency fund, and then the conservative bucket, typically like a fixed asset bucket, where you have more stable type investments, things that are going to generate returns consistently and conservatively. And then you have the last bucket that's a little more further away, and that's the equity bucket, the business ownership bucket, which are more stock market linked assets. And that's really where you're going to get the inflation protection and the growth. And then, the other bucket, the fixed asset bucket, is more where you're going to get the safety and security to give you an income stream.
Yeah. And so then you have to also factor in, we're putting money into the bucket. We got to figure out the right bucket, the right mix. But then also we need to kind of look forward and say when we need to access those, we need to make sure we're going to access the money in retirement and through retirement in the best possible way. So it's kind of like that whole flow chart. You got to look at it before, during, and after, or beginning, middle, and end, and there's all kinds of considerations at each stage, and that's where you guys can sit down and kind of, like you said, know those numbers.
Exactly, and that's something else you reminded me of. Is there's so many of these advisors out there. They use these planning softwares that are very, very complicated. They spit out these numbers and say, you have a 85% chance of success, and you're like, okay, well, what does that mean, really? What 85% chance? So there's a 15% chance I won't have success.
Yeah.
But what we do is we use a software that really lines up all your assets on one page, and it shows you year by year by year where you're going to get your paycheck every single year. And so we can strategize and do different scenarios of, look, this money over here is going to be more conservative. It's going to be the tax-free bucket or the taxable. We're going to take that money in the next 3 to 5 years. Then, bucket 2 is going to kick on, and we can really, allocate assets and allocate a strategy for each specific account to create that paycheck for the rest of your life versus, so it's really more of like a distribution and an income planning software versus just saying, you have an 85% chance of success and you're not really knowing what to do with that.
Yeah, you can just kind of dial it in and really get granular on that, it sounds like to me.
Exactly. We can go specific by specific, and we could show people how you are right now versus if we do this switch and position it like this, what is the outcome then? And is that better or worse than what you're doing? And it's very clear. And that's something we can update over time every year to 2 years. So we can see, okay, what are our projections versus what have the results been? And so we can catch sort of anything that's out of line before it becomes a real issue.
Yeah, that's got to make people feel comfortable, because it's like sometimes it's like when you sit down and you do like some planning, personal goal planning or vacation planning, it's like, okay, that just feels right. I know my path forward. I know what I need to do this week, this month, next year, things like that. And I think that when you can see that dashboard kind of and see exactly where you stand now, where things will look, given these estimates, and then you keep your eye on it. You don't just set it and forget it. And I think that's a big thing people need to realize is there might be some volatility, so give it time, but also it's not a front end set it and this is you've got to keep your finger on the pulse of what is happening to make any adjustments potentially needed.
Exactly. Yes, correct.
Well, Andrew, if someone is interested in seeing what that could look like for them and maybe what that picture could be, maybe for a second opinion on their portfolio, what's the best way someone can learn more about you guys and also reach out and connect with you?
Our website's barnettcapitaladvisors.com. And anyone can call me at 305-328-8538. And my extension will be there first, and extension 1, and I'll be happy to talk with them about their situation.
Excellent. Well, Andrew, thank you so much for coming on today. It was a real pleasure talking with you.
Oh, thank you, Mike. Great speaking with you as well.
You've been listening to Influential Entrepreneurs with Mike Saunders. To learn more about the resources mentioned on today's show or listen to past episodes, visit www.influentialentrepreneurssradio.com.